Welcome to the Traders Show. This episode is brought to you by Paperstone.
Greetings traders and welcome to another episode of the Traders Show. This show has been brought to you by Paperstone. On today's show, we're going to talk about the current market environment, current market, stock market outlook, current crypto market outlook, forex, commodities, the events happening in the markets geopolitically, in terms of fundamentals. Also, we'll try and look at what's happening fundamentally and how it's affecting the general market outlook. We will try to give our own personal ideas of where we think markets can go moving forward. But this is not investment advice or advice to buy any securities. So this is just our own ideas, and we're just trying to share with you guys where we believe markets are and where maybe they might be going in the next few months. So today I'm joined with by my colleagues, and I let them introduce themselves. Caleb, Ken.
Cool. So yeah, guys, welcome to today's podcast. As Taras has said, we're going to talk about the current stock market and the outlooks we're seeing. At the end of the day, we normally say this is not financial advice. This is just our own opinion, our own biases of how we are viewing the market. So we'll do a short breakdown just to talk about what we are seeing and what we expect to happen in the next few weeks, next few months, especially in the long term. There's a lot that has been happening, especially with the interest rates coming back in, the Fed's trying to control inflation and all those things. So it's good to catch you guys up on it and keep you guys updated. So that's it. I look forward to sharing a lot with you guys. And yeah, it'll be a good, fun banter with us. Ken?
So hello traders, welcome back to another episode. Like my colleagues have said, today we're going to dive into what is currently happening in the market. There are very many interesting things. Asset prices are also moving significantly. We think there's a change in trends. Things have been moving up for the last around 2 years, from 2020, the whole of 2021. But I think beginning this year, around February, January, we started seeing a slide in the markets. And we're going to talk about what that slide means, why it's happening, where we think it's going ultimately. But like my colleagues have said, again, this is not investment advice. This is just us sharing our outlook, us giving our opinion. In fact, if you come to the office maybe 3-4 weeks later, we could have changed our outlook on everything that you've said, and we could be trading very, very differently. So things change in the market, and a good trader needs to adapt to what is happening in the market. That's one of the top qualities of a good trader. We believe in adapting to what is currently happening in the market, because if you had asked us in October to give you our market outlook, I'm sure it will be quite different from what we'll be sharing today, because a lot has changed between that time and what is happening right now. So for us, we observe those shifts in momentum.
Paperstone gives you access into the global markets with more trading opportunities, first-class customer service, and peace of mind. Withdrawals are quick, and for those in Kenya, M-Pesa is enabled. Paperstone Markets Kenya is regulated by the Capital Markets Authority. To open an account with Paperstone and begin your trading, click the link on the description below.
So to start off, I think the main point that we can start with, I was thinking of how we could break it down. I think we can start with the fundamentals, head to asset prices, and then we can look at some of the technicals.
Yep.
For the technicals, we could even attach some charts. We'll just talk about them because we have the charts, I'm sure, behind our minds. We know where different asset prices are, the different patterns that are from those markets, what we think will happen. But when we upload the podcast, we'll try and integrate some of those charts for you to observe some of the things we're talking about. So to start off from the fundamental perspective, I think for me, I'd say there are a couple of key drivers that are pushing this market up or down. And one of the key drivers that is really a problem that the central banks are trying to control across the world is inflation. So I think inflation is where we can start off. And to start off, I think the right point for us to start off with is, why do we have inflation? How did we get to inflation? And how do we solve it? And is it parallel to any time in history? So I think that's where we can start. So one of you could explain how inflation came about. The other one could explain how it's solved. Okay. Then another person could tackle the historical perspective of inflation and what we think will happen currently.
Okay, I think I'll tackle the first part. And as our friend Redalio says, it's always a cause-effect relationship in the markets and also in life.
Yeah.
So it's a sequence of, you do this happens, you do this happens. Or you're caught up on this scenario and you have to do something to maybe control it. And it started with COVID. COVID is the first thing that led to the printing of money, which is basically having very, very low interest rates, and the open market operations, the quantitative easing. So when COVID came into them, when COVID came in 2020, it sent a shockwave to central bankers around the world. Employment was very, very high. In the US, about 16% from a low of 3.5% in less than a month. So that was the central bank always have this dual mandate to control unemployment and to control inflation. So at that time, inflation was not a problem; it was unemployment due to
That's
COVID.
what you call monetary policy,
Yeah, monetary policies, which we dive deeply into in our courses on fundamentals. So
and they shouldn't confuse monetary policy and fiscal
policies. Yeah.
True.
They're very different. Monetary policy is for the central bank. Fiscal policy is for the presidency. So the central bankers around the world, starting with the US, lowered interest rates sharply in 2020. I think US from 1.75% to 0.25% on an instant emergency meeting. Stock markets at that time were down almost 35%, 38% before they lowered interest rates. So in an effort to try and reduce unemployment and stimulate growth in the economy, they had to print more money. They had to put more money into the economy through quantitative easing. And I think they gave out about $3 or $4 trillion, somewhere around that. Which is, I think they printed about 20% of US dollars in 2020 to be able to sustain this, the supply of dollars they needed to give to the economy. So in an effort to sort unemployment rate, which was at 15%, they wanted to bring it back to about 3%. They had to lower interest rates. So lowering interest rates, basically you're pumping money into the economy, and at that time that was sort of devaluing the dollar. So the dollar lost a lot of its value in 2020. I think about 13% of its value was lost in 2020
for 1 year.
Just for 1 year. Then after a year and a half, unemployment was sorted. Sort of coming down to normal levels below 6%, 5%. And I think we're now maybe at 3%. So the labor market is stable in the US. And that is one of the mandates maybe which they have solved. But as they were trying to do that, now the effect was they caused inflation. Basically, there was too much money in the economy chasing too few goods. That was one of the major things that caused inflation. Basically, the lower interest rates. Another thing was global supply chain disruption, especially in the US. There has been a very, very, almost for the past 10 months now, there's still a problem with supplying goods from the ports to the inland. So there's still a lot of global supply chain problems. In the US, in UK also, there's a lot of that also happening. So that comes second in terms of increasing inflation, because now supply of things becomes tough. So supermarkets maybe are short of goods or stuff. So prices of goods continue going higher. Then over the past 2-3 years, there've been a lot of events happening. Russia-Ukraine came again lately. I think now for about 4 months, there's been that war causing a lot of indecision in the oil market. So oil markets, looking at oil is not about, I think yesterday we traded towards higher, about 124, 125. Not sure, which is close to the previous high of 129. So oil again is very, very high. Oil is one of the major drivers of inflation. And that is why inflation is a global problem. Not only in Kenya, not only in the US, not only in the UK. It's a global problem, and it's I think we are getting to very, very high levels. I think in the US yesterday we hit another high of 8.6%. Markets were expecting 8.3%, but inflation was higher than even market expectations. And we saw what happened in the gold market. Gold market had a sharp move to 1825 somehow. Then went up again about 500 pips from that level again to trade at as high as 1875 in
a span of 6 hours.
In less than 6 hours. So bringing a lot of volatility into the market because of inflation. So I think that is the main drivers of the markets right now. Like UK also are facing a 40-year high inflation rate. Same to the US 42-year high inflation rate again. And now that is again what the going back to the dual mandate, that is what central bankers are trying to solve again. So you've solved unemployment, But on this other side, inflation has become a worry. Most central bankers in the world target around a 2% inflation rate. We are now at 8.6%. That is almost a 400% breach of your target. So the fact that inflation is way, way too high, that is now what we are now trying to see how the central bankers will come in with a speed of tightening now the markets. So will they increase interest rates faster? Will they increase interest rates at a steady pace, but slower, but consistently? So that is what I think most market participants now are trying to focus on, like how fast or how slow will the central bankers increase interest rates? And now that also will send same message to the markets. That will mean how faster the markets will also drop, or the increase in volatility in general markets. So I think that is the relationship between unemployment, interest rates, and inflation. So that is the three main drivers that we are trying to watch, the three main fundamental drivers that we are trying to watch to see how eventually the central bankers will tweak interest rates. We saw ECB, they had a meeting, I think, on Wednesday. On Wednesday or Thursday, I'm not sure.
Thursday.
They had a meeting on Thursday, and they said they'll now start increasing their rates in July. They are also cutting out their QE again. So they're cutting their QE again. And on July now, because I think they are the one at zero still. They've not increased rates apart from Japan. So looking at
Japan is still at negative.
Negative.
0.1.
Japan actually are doing QE as others are doing QT.
Yeah.
They're devaluing their currency.
Yeah, very, very badly.
And that's why you're saying the currency really.
The yen over the past few months, few
weeks
has been weakening very, very sharply. So
almost a few months, because I feel like
okay,
from 125
it's let's say a month. It's just that it figured summer
paused around March
and continued.
So a lot of fundamental drivers in the markets that are showing very, very clearly technically. We can see these moves technically, and we are also trying to trade both in line of technicals and also in making sure also you are in line with fundamentals. Because right now I think generally on the long term, okay, personally I think I'm very, very bullish on the dollar, very, very bearish on things like cryptos, stocks, commodities. That is my general outlook. But of course I'll have to take some buy sells on the way. But I have the long term outlook of the markets, trying to identify where the markets will be in the next 6-12 months. So I think that is on what is causing inflation and the current market environment and how markets will try to react. So I think
let me pick up. Can you do the history part? Yeah?
No problem.
So as Taras was saying, also I like this topic. It's normally a good topic to understand because you're understanding the cause and effect. As Taras has said, when this happens, it causes this other one to happen. When that happens, it causes this other one. So if I just take it back, as Taras saying, those people don't know what QE is. QE is quantitative easing, which is basically pumping of currency into the economy in a mass scale. So when COVID hit, there was a very quick drop in the stock market. Unemployment increased, as Tara said. So the Feds, in a way to control this, had to lower interest rates, then allow for quantitative easing to be increased, because now this allows for people to borrow money. And they do this, reduce it, give it into the system through the banks, then people take it as loans. So it's cheap loans, allows people to borrow more money, and then sort of try and kickstart back the economy, because you're investing back into your business, because the economy is basically the businesses that are running. So they're trying to it's like when someone is in ICU and they're sort of trying to pump you back. I don't know what they call it. It has a name. Yeah, but that one. So that's what sort of they're doing. And then they did what we call, what Taras said, going to between 0 and 0.25, which is basically what we call ZAP, zero interest rates policy, which just helps to kickstart the economy. Now, borrowing is very, very, very cheap. Now, for one whole year, remember, it was since May 2020 to May 2021, over there, that's where the dollar bottomed. And then it had gotten this trajectory and started moving up. Now, during that time, interest rates weren't yet increased. So sort of the market players, as we keep saying, the market is always ahead of reality. Yeah. So we started seeing investors starting to be bullish on the dollar, because we are seeing now the inflation is starting to catch up. Yeah. So being early in the market, they started taking positions which were basically to buy the dollar, because sooner or later they knew we had to stop the QE, reduce the QE, then start increasing interest rates. And that's exactly what we saw. November 2021 is when the Fed came in and talked about starting to tighten and reducing interest rates, and decreasing first the quantitative easing, and then they said March 2022. I remember that's what they'll start pumping up the rates. And now, as a reaction of what we saw in the market, because I like saying this and I say it a lot, because we're also talking about the technical aspect. Price action is all there is, and everything else is embedded in it. So when you look at the price action on the charts, everything is already factored in it. Panic sellers, buyers, everyone who's reacting, buying and selling. What we see in the market is a sort of a compilation of what has happened within that time frame. So now that's what happened. Now coming into November, December, January, now people are starting to prepare for the dollar, the dot plot, to start increasing. I remember in March, as a way now what I've forgotten to say, now during this time, we're starting to reach the height of inflation. Now it was getting high, 7.5, I think we got around there. So people knew one way or another we really have to reduce the interest rates, and as when increase the interest rates, and that's a control measure of how they want to reduce. It's sort of, if you watch videos, it's like pulling levers. It's a hard game. It's not really easy. It's not just if you reduce one, you'll control the other. You can try and do that and steal the other one. That's what we're seeing now. So it started increasing. You're still seeing inflation going up. So as a rule of thumb, I like telling students and my clients, when inflation is going up, prices are going to go up, but that doesn't mean the value is going up. Okay. For example, an example I like giving, let's say we have this phone. So this phone is the only phone that exists. Okay. And the only money we have in circulation is $10. Okay, that's the only money in circulation. But then the government comes and doubles the money in circulation. So may I have $10 and Ken has $10. So people will be willing to pay more for this because there's more circulation. Okay, so it doesn't mean this thing has increased in value, but there's more money chasing the same amount of goods. So as a rule of thumb, people will increase the price of the phone to catch up with the amount of currency that is circulating. And that's exactly what we've been seeing. If you pay attention to things like Coca-Cola 300 ml bottle, kitambo used to buy that thing for like 25-30 bob. Now we're paying, I don't know how much it is now. No, kitambo used to be like 20 bob. Yeah, nice, sort of, you can pay 50 bob for it. Same size, same drink inside. Hakuna quality may increase, but the value is the same, but the price has increased. So don't confuse the two. Just because something is going up in value, in price, doesn't mean it's increasing in value. So now the Feds need to come in and control the inflation, because inflation is really going up. Prices are becoming expensive. Like you're saying, oil around the world has been increasing. Okay, and as a rule of thumb, what are also saying, when inflation is going up, oil is going up. When oil is going up, and I think this Ken, you're the one who taught me, when oil is going up, it affects the whole market, and inflation, prices of things start going up, is because oil runs the economy. Oil is a black currency around the world. So when oil is going up, remember, you're using oil to transport goods. You're using oil in manufacturing sites. You're using oil in air transport, cars, in shipments. So if oil is going up and you're paying more for oil, of course, if you're selling goods and you're shipping them, you're going to charge extra prices. So as a rule of thumb, everything is going to go up. So always keeping that in mind. As much as you see oil continuing to go up, also prices of goods are going to go up. So now governments are coming in around the world. Now, this is what we're paying attention to. I remember we were expecting the first interest rates from the Feds to be increased by 25 basis points. But lo and behold, they did by 50 basis points. You remember?
The second time.
The first
time they did 0.25.
Then the second time?
50 basis points.
And it was followed with month 1, then month 2. It was back to back, yeah?
March and May.
Because right now we are at interest rates
1.
between 0.75 and 1.
We are at 1%.
1 and 1.25.
No, we are at 1%.
It's always a margin.
No.
It's always a margin.
It was a margin when it was 0 to 0.25.
Yeah.
But they raised rates now from 0.25 to 0.5. Then they raised in May 4th by another 0.5. So we are at 1%.
So trust me, it's 1 and 1.25. But we'll check it. We'll check it. It's always a margin. I'll check it out for you. Okay. But anyway, if you're at 1, so that's what happened. This is a way to now control the tightening, quantitative easing, by reducing the amount of currency they're pumping into the economy. As Tara said, in the past 1 or 2 years, let's say more or less, the Americans have pumped in 20% of the dollar that is in circulation, not only in America but around the world. So it's very, very important. When they do that, by default, you've devalued your currency. There's more, as I said, more currencies chasing the same amount of goods because productivity hasn't increased. By a rule of thumb, may reduce a bit. Yeah. So of course, things are going to catch up in terms of prices. Okay, they're going to be more expensive. Productivity has sort of stagnated or become less, and more currencies chasing the same amount of goods. If everything was moving up at the same time, you'd sort of not see that much change in. I think you might not see that much change in currency. Prices of goods, but the fact that productivity is still remaining the same, but money is being pumped up like crazy, of course you're going to see that. So as I was saying, around the world, as I was saying, the Feds are increasing interest rates. ECB next month increases. I remember Australian Reserve Bank of Australia also increased last month. So we're really, all the banks around the world are trying to increase interest rates to help control that inflation numbers and to catch up. And something I was telling people, especially like here in Kenya, if you look for like oil, not long ago was at 100, 110. Sindio? Now oil in Kenya has gone to 150. Okay, so let's say it was 100 and it's at 150 in 2 years. That's a 50% increase. But you, the person back at home, are still earning the same amount of income.
In fact, you could be earning less.
Maybe you're earning less, or maybe you don't even have a job. But the prices of goods and oil has gone up by 50%, but your currency, or your income has not even increased by any percent. So basically, you're being robbed. Your money has been robbed by 50%. So it's something you need to pay attention to. And also at the same time, if you're in Kenya, you're seeing the dollar against the Kenya has really gone down, and this is what we've been talking about. You really want to be paying attention to this. You can't assume and just say your money is fine or your pension is fine. By the time you're getting your pension 50 years later, the biggest time you've been robbed is the valuation of the currency by the time you started and by the time you're finishing. So these are important things you're paying attention to. I know most people don't really go that deep, but for us on this other side, we're looking at the markets from a back end, okay, from the deep side, deep state, okay. So we really have to pay attention to that. So as I finish off here, so the Fed's now coming to control the interest rates by increasing, the inflation, by increasing interest rates, then to see how the inflation can be controlled. But you're saying, by CPI yesterday, because I didn't really pay much attention, it was increased. Inflation is still going up. So these guys are pumping the interest rates.
They have to. Okay, it means maybe they'll have to be very quick in how they raise their rates. Yeah, because they promised 0.5% increase in the next consecutive meetings until it gets maybe to 2% or 2.5, maybe 3%.
Yeah.
So yes, they are promising that, but it depends now on the speed. Of how they increase rates, because the issue of inflation is now a more bigger problem than unemployment.
Exactly, and there was a time unemployment was. I remember there was a time people were paying attention to NFP. You want to see, and that's what was spiking the markets. Exactly. Now actually NFP, things have shifted.
NFP is cooled down. It doesn't have so much effects in the market, and inflation on the other side is affecting markets very, very strongly. Because if you see yesterday, the dollar actually really gained so much.
Exactly. And that's what I was going to say. As a cause and effect, now you're seeing what has happened. Stock markets fell yesterday. You're saying Nasdaq fell by what?
Nasdaq was down at 3.7%. Dow was down
over 2.5%. The dollar's really risen against that. Gold, a safe haven people will always rush to when stocks are really falling. We saw that one has risen from 1825, as Taras was saying, to 1875. That's a 500 pip move, which is a big move in the market. It's more than 1%, It's about 1.5 around there. 1.5. It's a big margin. So that's what we're paying attention to, guys, looking at how the economies are doing. Then Ken maybe can give now the history and give back what has been happening.
So for me, I think we just start off with what Solomon said. There's nothing new under the sun. Everything that happens has happened before. and probably will happen again.
It's Solomon.
The one from the Bible, the one you like. Anyway.
I did it to be specific. Yeah.
Okay. Also, Mark Twain said a very powerful quote along the same line, which was, history does not repeat itself, but it rhymes. So as much as you may not see the same exact scenario, there's some rhythm in it.
Yeah,
and I think
and as you continue on the quotes, sorry, something I was talking with Mitch yesterday in the office. I was telling her, because I learned it from the markets, it just came as a epiphany. What goes up must
come down,
what goes down must
go up.
not really. What goes down must not necessarily come up.
Why?
Because look at it this way: when we're going up, it's infinite. There's no limit.
Okay, but when you're going down,
When we're going down, when things go to zero, that's it. They might not. Oil went to zero, but came back up.
Yeah.
But stocks, companies crash, bankruptcy. You can go down, but not necessarily
come back.
That's
True. That's true.
So yeah, just continue. Sorry.
Anyway, so if we try to one thing that I learned when I was looking at trading, or when I was learning how to trade, was I used to study a lot of economics and trying to understand the cycles, what is really moving markets up. And one of the things I really understood was cycles. And cycles are, when I tell you we're in a cycle, it's something that has happened before, it's just repeating. So we are maybe in the beginning of a cycle, the end, the middle. We don't know which part we're in the cycle, or you could know which part you're in the cycle. And one cycle could be the same to another cycle. For example, if we look at the current market environment, I think the best period we can compare it are two periods. One is the 1970s, when we had high inflation. We had oil shock. It was called the oil shock. During that time, oil prices went high because of the war. There was a war between Israel and some country.
Also Vietnam and US.
Yeah.
This was
1970s, around 1970s.
Okay.
And during this time, oil prices really shot up because there was no oil. Like the Gulf War had
crisis.
There was a crisis. There was an oil crisis, and that led to very, very high inflation. And I remember one person who was very, very influential in bringing that inflation down was a guy called Paul Volcker. So Paul Volcker by then was the chairman of the Federal Reserve, and he had to hike rates aggressively. So he never hiked rates by 1 basis point or by 0.5 basis points like you guys were saying.
Yeah.
He was hiking aggressively and over a long period.
Yeah.
And that was the only way he could be able to combat inflation and bring things down.
Yeah.
And if you look at the effect, I think the same thing is repeating itself right now. So one thing that has to happen for this inflation to come down, one thing we're very, very certain must happen is interest rates must go up.
Yes.
And I think the market is already telling you that. The fact that the dollar is rising, the fact that stocks are going down, cryptos are going down, gold has also been selling off. Other than the move higher yesterday, gold has generally been selling off.
Yeah.
We came from about 2,000 all the way to trade as low as 1,800. We found some support there, came to about 1,850 where we've been trading now for the last, I think, a week. And now we saw that move yesterday after the inflation number came out.
Yeah.
So if I just compare these two periods, I think one of the things that I'm really learning is, one is if rates go up, those are some of the questions that I'm asking myself. I always tell people, trading is a matter of just coming up with probability distributions. Just thinking about if this happens, then this is likely to happen. For those who code, understand, or for those who who do computer programming, I think there's something called if-then statements. Like, if this happens, then this computer should do this. If this happens, then this should happen. So if you come to the markets, it's almost the same. We know if rates go up, the stock market will go down. Right? It's quite simple, because if you hike rates, you're basically doing what you're discounting earnings for companies. If you discount earnings for companies, it means they have less money. If they have less money, their share price has to go down because they're not as profitable as they were when you were starting out. The same happens to markets like commodities. Okay, why? Because when rates go up, most people will take their money out of commodities and put it into dollars.
Yeah.
Why? Because the dollar is yielding more than these commodities. Commodities don't yield anything. In fact, most commodities make money just from speculation.
Change in price.
Yeah, it's change in price. But when you go to the dollar, as much as you may be holding it and it's not moving, the fact that it's yielding you maybe a 0.5, 1%
interest.
it's quite good. So you'll find that most people will rush to the dollar. The yield curve, if you look at the yield curve, the 10-year yield curve, which is basically an extrapolation of long-term interest rates, it's quite high. The yield curve tapped about 3 point
3 point
something.
something,
Yeah. We're coming all the way from lows of about 0 point something to trade as high as 3 point something. We've
Yeah.
broken a major crucial trend line
Yeah.
on the monthly chart, which was suggesting that markets will stay down for quite some time.
Yeah.
But it's been taken out. That means rates are likely to keep on moving higher.
It's on the yield.
Yeah, on the
Okay.
yield curve.
Okay.
So rates are likely to move higher. And this period is more like the 1970 period. Another period you can compare it to is the 1939 to 1945 period. This was the Second World War. Wars are similar. I think it's so funny that some of these things just happened together. For example, in 1939 to 1945, there was the Second World War. Currently, we have the risk of going into a Third World War with Russia invading Ukraine. We still don't know the outcome of the war, how things will turn out. So that's also a major problem that is embedded in the price of the market, or is a risk that is embedded in the markets. As much as markets, markets are very funny. Markets sometimes may not pay attention to something until it becomes a major problem. Until people start, I used to tell people, initially I thought if you care about something, you just act on it. But one thing I've learned from trading now for quite some time is, as much as you care about something, you have to wait until everyone else cares about something, because that's the only way it will be reflected on the price. So you may be right on the direction, but wrong on timing. So for you to get both, you need to wait till other people start caring.
Yeah.
Not everyone, but at least some people who are enough to change the direction of the market, maybe. For example, one line of thought that I like telling people nowadays is, I don't want to short the Nasdaq, let's say at 17,000 when it topped. No, I want to short it at 16,000 when it's coming from 17,000.
Yeah.
So that way, the probability of being right, rather than saying it will top at 17,000, I just want it to top, let it give me a signal, let it start sliding, then I'll look for my short positions once it's moving lower. So I don't want to be the one calling the top or the bottom. I want to be just take part in the middle part of the move once things have changed. And I think that's what's happening currently. Look at Bitcoin. Bitcoin has come from 65,000 to trade as low as 30,000. How far lower will we go? We still don't know. If inflation is going higher, then rates will go aggressively higher, like Lavi is saying. If rates will go aggressively higher, most of these markets will sell off aggressively. And I think yesterday was a representation of what is likely to come.
Exactly.
Dow sold off about 2.8%. Nasdaq was down about 3.8%. Those are big percentages to sell off in a day. If you're trading, those are not things that happen on a day-to-day basis. They're outliers. They're things that just happen once or twice, three times or four times, probably even in a year. So it's very, very important to look at some of these things as potential signals to where the market is going.
Yeah.
And I think for me, it's quite clear. Unless things change, and I don't see that. Currently, I don't see that pathway to change. I don't think there is any way they can combat inflation without hiking rates aggressively. And there's the risk that as they hike rates, they'll send us to a recession.
Yeah.
So there are very many risks which are coming, and I think markets have to pay attention to those risks.
Yeah.
Exactly.
And as much as we may, because I always like telling students that, again, markets are like a leading indicator. So the market will not wait for the economy to be in a recession for it to reflect that you're going into a recession. Long before we're in a recession, the market will have sold off. And when we're in a recession, as we try to come back up, markets will have come back long time ago again. So markets are just in a world of their own. They're like leading actually what the Feds will do. Because again, I do believe also that if markets sell off aggressively, the Feds will also be put in a tight spot.
Yeah.
Exactly.
In
That is
that,
the risk.
exactly. In that they won't now have the confidence to hike aggressively again. Because markets are telling them, the more you hike, the more we sell off. And the more we sell off, the worse the economy will be.
So they're at a fix.
They're at a fix. And that risk is now going to a period called stagflation.
Yeah.
Stagflation is where basically inflation is going high, but no growth.
Yeah.
That's a very dangerous thing again.
Now that's stagflation.
That's stagflation.
You said what?
Inflation is going high,
But no growth.
Why is there no growth? Because interest rates are going up. It's hard to create an environment where there's growth in the economy if rates are going up. It's almost impossible.
Yep.
You really need a strong economy for you to be able to do that. And if you are keen to look at for example, if you watched Lagarde or if you've been listening to what the Feds are saying, they don't want to admit it, but it's true. They were wrong. They could have started hiking rates sometime last year in July, sometime last year in June. That was when they were supposed to start hiking, but they got late. They allowed the market to just keep rising higher, the economy to just keep ballooning. But what they forgot was, as the economy is ballooning, the inflation is also going extremely high. And now inflation is at a point whereby they're forced to move very, very fast. And as they move very, very fast, I think the biggest risk again is they send the economy to a recession. And as they send the economy to a recession, it forces them again to think of how again we'll come out of the recession and go back to a period of growth.
And for those who don't know, what's the disadvantage of having inflation's continuing going up?
Inflation basically means the price of goods is rising high. Like you said, you explained it in a perfect way. You're buying this for $100,000, it's $1,500, and your income is not rising.
Exactly.
So your income it's like you're discounted. Your
Being robbed.
purchasing power is it's like
Being
you're being
robbed.
robbed.
It's
Your
gone down.
purchasing power is going down. So if you have an economy which that is happening, for example, in Germany, if you want to understand inflation well, go back to Germany in a period called
Weimar.
the Weimar Republic.
Weimar Republic.
The Weimar Republic. That was when Germany understood the cost of inflation, hyperinflation.
Yeah,
In fact, they had to devalue, they had to come up with a new currency. Those are also some of the things that could happen. As we try to fight the inflation, we could end up coming up with a new currency. Or there's a risk of the dollar not becoming the reserve currency again, because many people are losing trust in the dollar.
True.
And you'll see people now are turning
Shifting.
to other currencies. But I think also the risks of that happening are quite low. Why?
Yeah.
Because I don't think there's any other democracy which has developed or matured as the United States democracy has matured.
It's a long-term change.
It's a long-term change which will take quite some time. So it's not something that will happen just overnight. But I think
Because the dollar has been supremacy in terms of reserve for more than ever since gold standard periods.
Yeah, the dollar has been
Better 100 years.
for quite some time.
For a long time.
I think one thing we have to remember is whoever wins the world war basically controls the other people. So I think the minute the United States was among the people who contributed to the Second World War ending, that meant a lot of respect from different countries. And that meant that their policies had to be adopted by very many countries across the world.
So to shift that, do you need to go to a war? Because Americans wouldn't just let it go.
That's a good question.
Yeah, they'll fight for it.
That tells you what is currently happening and the risks of what could happen. Because, for example, if you look into the works of Ray Dalio, like the changing world order, he's basically saying, yes, we are shifting. The shift will take time, and we don't know how that shift will happen. Will it happen peacefully?
Yeah, true. That's the question
That's
now.
the question. Like, will for example, right now the people who are likely to take over that spot is China. It's no secret. It's China versus the US. And the question is, will that transition be peaceful? Like, we currently have a trade war. Actually, the ongoing trade war is also part of the reason why we have high inflation. One of the ways they can also combat the inflation is doing what? Removing the tariffs that they've imposed on countries like China. But also that means they're surrendering, because China doesn't have a big inflation problem like the US. They have it, but it's not as big as the US. I think the US have the biggest problem currently.
I think China
across
have
the
2%
world. Inflation. You see, so
which is stable.
it's quite
Of
stable.
course, yeah.
For them, they don't have that major problem because they didn't pump as much money as the US did during the COVID crisis. As much as they pumped money, they didn't pump as much. And you find that even now there's that rotation from the US to people investing in China because they think the Chinese market is at a better standpoint. It's not at the risk of selling off like the US market. So it's quite funny. Now the question is, again, as we move now to the next topic, which I can start off with, is how low can we go? How low? It's not a matter of are we going low? It's how low.
Yeah,
it's
how
no
low.
longer it's no longer a question of will this market sell off? No, it's a question of how far will it sell off? How far? And the technicals are quite clear. For example, if you look at a market like Bitcoin, we've been watching it with Lawi. We think there's a high chance we'll trade below 10,000.
Yep, very, very high
There's
chance.
a very high chance we'll trade below 10,000. Anyone who thinks he's buying the dip at 30,000, unless you're buying the dip from 30 to 40,
60% more to lose.
bus, you still have a long way to the downside. And I think one thing that I'm also learning is most people who are participating in markets are just focused on what is happening on the price.
Yeah.
And-
You don't understand the back.
And some of these axioms that are used in the markets, for example, buy the dip, like buy low, hodl, like you're just
HODL.
you're just following things which you don't even understand why they were there. You get?
Yeah.
So it's a very, very bad dynamic. I think there's a high chance a lot of wealth will be destroyed during this period. Because I also think the guy who'll buy at 30 will not be able to hold it when it goes below 10,000 because he does not expect it. There are two things he doesn't do. He doesn't expect it.
Yeah.
If I buy at 30, I'm expecting it to go below 10,000. So when it's going to below 10,000, I'm not really
Surprised.
scared. Yeah, I'm not surprised. So because if it goes below 10,000, that's about a 70-80%.
That's what I was saying. 65 if from 30, about 65%.
No, from 60 ways.
From 70
Oh.
to be about 85%.
Yeah. Now from the top,
Yeah, from the top, which is not a surprise.
It's not a surprise. Most of the Bitcoin, it went 20,000 and back to 3,000.
So
Unexpectedly, that was more than 75% decrease.
And that time, you remember, there was no big factor pushing the market down. For example, we didn't have inflation, we didn't have rates problem, we didn't have all these problems which are currently there.
True.
And it sold off that much. Now compare that to what we currently have. I don't think personally we're in a period where you should be buying anything yet. As much as people are saying they're bargains, I still feel like we need to watch two
will
things.
happen.
Yeah, we need to watch one, will we have a soft landing? How far will the recession go? That's a very, very good thing to watch. How high will rates go? How high will inflation go? Those are the questions. And like yesterday, I was looking out for the inflation number because one thing I wanted to track, for me personally, I do believe also that some of these problems don't end when you stop seeing, for example, inflation won't end. The problem won't be behind us, or markets won't pay attention to inflation when it comes back down to 2. No. What will happen is markets are just watching. When will the trend change? When will you stop moving from 8.6 to 8.7 to 9? And when will you start from moving from 9 to 8.5, 8.5 to 8.3, 8.3 to 8, 8 to 7 point something? Once that is established, inflation is going down, and I think the regime or the theme of the markets will change because again, they'll have priced in now the risks are over and something is coming over. But again, something else will develop. So I think until we see that shift, and that's what I was looking for yesterday, because I remember the previous number was 8.5, we went to 8.3. I was looking, will we go to 8.1? If we went to 8.1, maybe the rate hike was working. But the fact that we jumped to
Gone back up.
8.6,
That's why the reaction in the market was
exactly. That's
heavy.
why there was such a very aggressive reaction in the market. Like there was a huge sell-off, a huge bounce in markets like gold. Because now it's quite clear, as much as you guys are saying that you have a 50 basis points rate hike coming, one thing you don't have for certain is this thing will not control the inflation. The money you put in is so much that you'll have to hike way more, and markets have to price that in. Have to sell off more and have to go lower.
The Feds have a tough time.
They have a very, very tough time. It's not a very easy job.
It's not an easy one.
Paperstone is an award-winning online global forex and CFD broker. It offers unparalleled service, exceptional pricing, and quick execution speed.
And on the point you're saying about prices of, especially in crypto, there's a friend of mine, a crypto enthusiast. I posted that on my story that cryptos might trade below 10K, as you said. Hey, and she came to my DM. Where are you getting this analysis from? So
You're touching a deep spot.
You're destroying someone's
I've been
fortune.
seeing this crypto guys. You remember when there's a time crypto had stopped kidogo, it started pumping kidogo before this now sellers come.
Came to
They
even
started coming.
45.
Things were moving up. Things were moving up across the board. Solana, everything. I remember people are posting, look how gains. Right now, silence. Even most people I'm seeing wame change. They're selling
I
other
don't want to
things.
talk about crypto.
It's changed narratives.
That's human nature. That's human nature.
So
And one of the reasons she was saying that, back in, because me I told her, historically it has happened, it can happen. Markets are more irrational than rational.
You try to explain your understanding of markets.
And she was like, in 2017, there was no mass adoption. And
now?
also, looking at the mass adoption, it was mass adoption by the damn money.
Exactly. It was not even smart money.
You see. Exactly. Looking at also the indicators, just like how the stock markets fell into it. There were companies going bankrupt.
Yeah.
The other day we had Terra going 99% down, losing about $73 billion of people's money.
Yeah.
See, so the fact that such indicators are coming way early, I could show this can go down, this can go down. So people don't really understand, as I said, markets are more irrational than rational. If oil went to negative $34,
it can go.
Oil, an asset which is right now at $125.
Yeah.
You see, so anything can happen. Even Bitcoin can go even to less than $1,000.
Yeah.
Because then in the markets, nothing, like we don't know what will happen tomorrow. You see, like we are always just trying to speculate.
Yeah.
And in the game of speculation, that is why risk management is the most important thing. And when you'll come out.
Yeah.
And remember how we normally say the fact that people don't believe something is happening is what makes it
Happen actually, yeah.
it opens the room.
They're the first ones to panic.
Exactly. Will happen from time
This
to
has
time.
happened. They come out. The smart money are not even coming out. They can even hold it to less than 3,000.
Because like me now, I'm looking at if it gets below 15,000, I think I can start buying.
Yes.
Good prices.
Yeah, those are good
now to buy,
prices.
yeah.
Because at 15,000, yes, it could go down. I don't think it will end. If it's
Now you
zero.
can
I
start
don't think
the
it
dollar cost and all.
Exactly. But at 15, as it goes to 10,
Yeah.
I'm not saying 15 is the bottom.
Yeah.
Yeah.
If it goes to 10, I'm not surprised. 5, I'm not surprised.
The
3,
better.
I'm not surprised.
The better.
So, yeah,
better.
I'll just keep buying and buying. But you really have to pay attention to what you're doing and understand the context and like you just don't need to look at one asset price. You need to look at one asset price relative to the context of the market.
Yeah.
Because I remember like when Caleb, we were coming out of most of our cryptos, there was that risk that probably we'll miss out on some gains to the upside. But we said we're not really interested in looking for more gains when what we should be doing right now is covering the gains.
Defense.
Yeah. We were exactly. We were now moving from a time of playing aggression to playing defense. And I don't think right now it's a time to play again aggression. I still think it's time to play defense. And defense right now is not fighting with the markets or it's staying out.
Yeah.
Like that's the defense you should be playing right
And that's
now.
the advantage you have compared to other people who just look at price going down. They don't understand what's driving it.
Exactly.
So as you're still having that caution, yes, let's stay out because of what is going on around the world. And we know interest rates affect every asset class, everything.
Exactly.
It's the backbone of the financial sector.
Markets, yeah.
Yeah.
So I think that the right thing right now to be holding, if you're looking for gains to the upside, I'd look for the dollar. I think the dollar has a high chance of going up. A carry trade is also very, very good right now. If
Against
you look
currencies.
At, if you look at
And that's why yen is really selling off.
off. Yeah, if you look at yen against the euro, yen against the dollar, those things are selling off aggressively.
Yen has been negative 0.1 since.
For a long time. It's
been long, yeah?
Since the 90s when you had the Japanese stock market going down almost 60%.
And when they have negative interest rates, what does it mean? They're paying the people?
Yeah, you're being paid to put money in the bank. You're paying the bank to put your money there.
Yeah, basically, like they want people to don't save. They want people to spend.
Spend.
They want people
They're
to,
devaluing their
like, They want
currency.
people to maybe do businesses instead of coming and put money.
Use
in the
this
bank.
money, you
Yeah.
see,
Yeah,
backing.
actually, going to the bank to borrow money is easy.
Because if you have positive interest rates, put money in the bank,
You earn
it's
something.
it's going up. But now it's vice versa.
Yes, exactly.
And that's why there's the carry trade, because I'll go to Japan,
Of course.
take that money,
Yeah.
and go and buy some euros and then hold, because those euros are likely to go up. So I'll make some money from
Against
that
the
carry
yen.
trade. Yeah, because the yen now, they're paying me to take that loan. Here they're paying me to give them money. So I'll give them the money and
Just common sense.
it's just common sense. So that's why you can see the yen moving up quite aggressively.
Moving down.
Yeah, moving down. I mean, quite.
But the Japanese economy is quite strong now.
It's strong.
Very strong.
So these are economic factors that you need to understand and balance.
Yep, because if you devalue the currency, it does not necessarily mean that your economy will do what. It could actually help your economy do well, because imports
And this is what
relative to
they
exports
did in
become-
1989.
Yeah,
They
when
strongly devalued
their
to
currency.
help the economy come back because they had a sort of a crisis back then.
Yeah, that was actually the time now they started going into negative rates. They were the first country to ever try such a policy.
Yeah, because I've never seen, and they've maintained it.
And they've maintained it. And I think they're the only country. Europe went to negative rates.
No, zero.
I've never seen that.
Okay.
I've never seen
Zero.
negative.
Just zero.
Europe.
Europe. And
No.
I always say this because I'm always the one who teaches fundamental. And if you want to understand all these fundamental factors deeply, you can choose to enroll to our courses.
Yeah.
I always say if you want to understand the impact of interest rates in the markets,
Yeah.
is look at what has happened in USD ruble. When the war started, the ruble lost about 50% of its value in less 3 to 4 weeks. Then Putin akaona hapa imekuwa hot. So from an interest rate of 9%, he commanded the central banker, which is not, that is dictatorship. Central bankers should do what they do on their own.
Yeah, they should not be told what to do.
Putin stepped in
Putin, I want 20% interest rate. Immediately. From 9% to 20%. And if you now look at the technical aspect of how now the ruble has become stronger, the ruble is now way stronger than the USD. before the war and until back to 2017.
Serious.
Yes, ruble is way stronger.
Rubble is all-time highs in the 5 years.
Yeah, in 5 years now. Ruble has now a 5-year
All-time highs.
All-time high. Because now the guys who are the first 3 weeks who are quickly liquidating their ruble to maybe buy other assets, they're now surprised. Hey, if I just keep my money, I'm getting 20% interest rate. Dollar huko ni 1%. You see, so you can't. Everyone now who was selling the ruble came back now in very strongly. Ruble has a V recovery, very strong V recovery. It's up, I think, now more than the dollar, about 12-15%. So that is for you to understand the effects of interest rates and how sharply they can move markets. Because I always say fundamentals move markets, then technicals helps us take advantage of those moves. So that is why you always have to have a blend of understanding both. You can't just, okay, some people, yes, are pure fundamentalists, some people are pure technicians.
True.
But for me, I believe that blend of both, like trying
important.
to understand interest rates especially, and how they drive markets, and also now of technical aspect, is very important. And that is what I always teach in my in our course. We don't just want you to understand charts. We want you to also understand how such current market environments affects markets. Because maybe people are even wondering, why are cryptos going down?
Yeah.
There's nothing.
No
negative news
Doesn't
about
make
cryptos.
sense.
Technology bado iko. Technology ja change bado.
Exactly.
Lakini inaanguka.
And markets are still going down. So it's good to always understand fundamentals, because it even gives that confidence maybe as you trade. In the maybe most of your trades maybe will be in that direction of the trend of a long-term trend, you see. So
Buying the dollar for the past 1 year.
So one thing by the way that people can do, that is one thing that I personally have done in line with what you're saying, is just create a table, a simple table, list on one column have the list of fundamental factors you're tracking. You could have the first one, obviously, which is the most important, interest rates. You could have the second one, which is very important, inflation. You could have the third one, which is very important, debt to GDP ratio, the debt that is in the economy. You could have the fourth one, which is actually unemployment. You could have GDP growth. You could have which are the main ones, the main indicators that you can track.
Those are some of the main. Some are GDP.
You have said about GDP, interest rates. Geopolitics is also quite important. Yeah. And then just do your research historically. How do things perform? On one column again have stocks, commodities, currencies. If you're trading those cryptos, you could also include them. Just know if rates are going up, stocks down, commodities down, dollar up, cryptos down. But it's quite clear. If inflation is going up, commodities up, because commodities are basically like they're the goods you buy. Like this is a commodity. So commodities up, you could have. If inflation is going up, stocks up, because companies have to price in the inflation. If you are selling something at 100, you have to sell it at 120 to price in the inflation. That means more earnings for you. So you could have stocks up. Currency is down. If inflation is going down, it means the currency is basically weak. So if you look at the dollar, it was selling off aggressively as inflation was going up. So have currencies down. Then go to the next one, GDP. If GDP turns negative in a recession, what happens when in a recession? They have to lower rates. If they lower rates, stocks go up. So in a recession, you should be looking to buy, not to sell anything. You should be selling when things are going well and buying when you're in a recession. Don't do the opposite. Don't try to buy when things are going so well and then you sell when you're in a recession. No. If you sell when the economy has just gotten into a recession, you're too late. The market has already priced in that. The market is always a leading indicator.
Yeah.
Like we like saying, it's always 6 to 8 months ahead of the economic reality.
Yeah.
So you can imagine if we're in a recession, the stock market got there 6 months ago and is now beginning to move higher. As they tackle in the recession, which means lowering rates, QE, a fiscal policy like taxes being brought down, pumping money to the economy, that means basically that stocks are going up, commodities are going up, gold is going up. So have that table and then track it. And then use your technicals. I'm not necessarily telling you to trade this. Because you could write sometimes, yes, rates are going up, but you'll still see stocks are going up. Then you'll wonder what's happening. Then you look again and you'll maybe discover that this time, yes, rates are going up, but the economy is so strong. So it's not really going to knock off growth. That means companies will still go higher. So you need to have that table and then use that now in line with your technicals. Don't say I'm selling this because you're in a recession or I'm buying. No. Let price action be your guide, but let the fundamentals be your driver. So understand that correlation. I think that's why I can stop for today on that topic.
Yeah. I think that was quite extensive in terms of asset prices. We've tackled prices of cryptos. Of course, we are bearish on cryptos. Stocks also. I'm expecting in the long term, maybe we'll take out the COVID lows, even go lower. During just the next few coming months, maybe 12 months. I don't know exactly the timeline. Commodities also, apart from oil now, is being driven by a lot of supply and demand issues, so that oil can still be sort of out of sync with most markets fundamentally. Cryptos down, stocks down, dollar up, yen weakness, of course, as we've said. Yen, we're expecting some more yen weaknesses due to the carry trade. As we've said, most countries are increasing rates. For them, they are still at negative interest rate with no signs of increasing rates. So that is one of the reasons making yen very, very weak. And this is actually to give you a long-term perspective. Not that on Monday now you want to wake up and start selling the yen. No, it gives fundamental. It comes in the big picture perspective, and even if you don't understand it well, you might be coming in very, very late. Yeah. So you need to know how to time markets well, both fundamentally and technically. Yeah, exactly. And as you said, this is not any financial advice, so don't say the financial hub guys walisema to buy dollar can go down.
True.
Exactly. So I think you can stop there for today. I hope you've enjoyed this podcast. As I always say, this podcast has been brought to you by Pepperstone. So if you're trading with any other brokers, consider switching to Pepperstone. They have some of the best spreads, some of the best commissions also, good execution timings, simple transactions in terms of deposits and withdrawals. So you can check them out. You can check their website on the link below. And I think we will stop there for today. See you in the next one.
Peace.